that's where Bitcoin could actually put in a bottom and start performing along with gold.
Hello everyone and welcome to the Daily Crypto. We are back with another Gareth Soloway video for you guys, so make sure to watch till the end because he makes some very interesting price predictions that are backed by proper technical analysis. But before we get started, let's take a look at the Fear and Greed Index for today. As of recording this video, it is sitting at 23, same as yesterday. Currently Bitcoin and Ethereum are trading for 19,280 and 1,303 respectively. With that being said, let's continue with the video.
I think the key is to recognize that right now, the near term, which we're not going to focus on, very volatile, bear market, we're going to get bounces. But the question is, how low does this bear market go for equities as well as Bitcoin? And then can gold actually turn it around and really start to rip higher? And I think the answer is that the equity markets and Bitcoin still have downside. So what I'm going to do, we're going to look at like longer term charts. We're not going to look at daily charts. We're going to go to bigger time frames. When you go to bigger time frames, you tend to see bigger things. So let's start on the S&P here by going to the SPY, and we're going to go to the monthly chart. And the first thing that jumps out to me on this monthly chart is the bull run that basically was nonstop from 2009. Now, remember this, right? What started in 2009? And the answer is quantitative easing. And so you really have to look at even the dot-com bubble. I mean, it was sharp to the upside, but it wasn't that crazy compared to this run here. And so what that does is that makes me very nervous that we've pulled forward so much of our gains over the mid and long term that the markets are going to have significant further downside. In fact, if we're talking worst case scenarios on these spiders, the S&P 500, I think this is a worst case scenario, you could find yourself back to retest the double top high from 2000 and 2007. Now that's a worst case scenario. If we're talking some other ideas here, this would be kind of my best case scenario, which is the connector from 2009 here, here, and here.
There will be multiple fake bounces during this bear market, which is done by smart money to create liquidity. Gareth is bearish in the short and long term as the SPY chart doesn't look very good. We would see it drop to 2000 and 2007 levels, which of course is the worst case scenario, but not impossible.
Yeah. And so one of the things to keep in mind is that if you look historically at bear markets without Fed intervention, they last for a couple years. Like here, you had the S&P from 2000 all the way to 2002. That was the collapse. And then if you look at 2008 all the way to 2009, you talked about 18 months. So you really haven't had a bear market since 2009, even though you had a quick, sharp decline during COVID.
We haven't had a real bear market in a long time thanks to the quantitative easing by the Fed, which is why it is now imminent. We could easily end up in a 2-year-long recession if the Fed doesn't intervene in terms of money printing.
Basically 480 here, down to let's say 300. That would be it looks like that would be about a 35% S&P drop, I believe, maybe about a 40%. So it's getting closer, but it's not quite there yet in terms of the size and magnitude. Now, in all fairness, the 2008-2009 drop was bigger than what we saw in 2000 to 2004. This was a little bit of a less drop. But I think the bottom line is what we have to remember is that the drop that we're going to see is probably going to be in the realm of this move combined, somewhere with the average of these two moves. So my guess is we got about 50% downside before the market can really solidify itself, which does put us here or maybe even lower.
Gareth thinks we could see another 50% drop in the markets from here before the possibility of a bottom can be taken into account. We have had a 35% correction during the COVID crash, but this time it will be much worse because the macroeconomic factors have deteriorated severely.
During bear markets, the idea generally is that gold does well. And what you could see is that in 2000, gold bottomed out and actually did have a nice move up and even continued to run higher all the way into 2011. So, I mean, talk about a bull market. That was an incredibly strong bull market. We've then obviously had a little bit of a consolidation kind of. Really, what's interesting is this almost looks like a cup and handle pattern forming on gold as well.
Gold has been historically one of the best performing assets during bear markets. As Gareth showed us on his charts, it usually rallies during times of uncertainty and panic in the financial markets, and we could see it do the same this year too.
The Fed is really printing money, then you would think that they would. But my guess is the Fed isn't going to go back to printing money. Instead, what they're going to do is they're going to do it very, very slowly because inflation is still elevated. Maybe not 8%, but if you're talking like a 4% number or 3% number, the Fed's not going to want to print a ton of money, right? They're not going to go right to quantitative easing because then you're going to see inflation go to 20%. So what the Fed will end up doing is they'll lower rates, but they're not going to go right back to that printing. And I think that's the kicker, is that the economic dire straits will keep pressure on stocks because the Fed's not acting aggressively enough. But gold will start to see that safe haven asset where you don't want to be in stocks because they're not going up. But at the same time, the dollar's not going up anymore. You know, things are not really performing like they should. So gold is the ultimate recipient.
Gareth believes tech stocks will get hammered pretty hard because this time the Fed can't just go back to printing more money because it will cause inflation to become even higher. The only option they have is to slowly lower rates so that the economy isn't struck immediately. All these measures will result in gold becoming the safe haven among investors to protect their wealth from these drastic changes.
And again, this is now looking at a really long view of crypto, but I do think there's still downside to go in crypto, and you can see the bear flag on the monthly chart. So midterm, I still think you have downside to 12, 13,000, maybe sub. But I do think when the Fed really gets in that tight spot and you see rates begin to come down and the Fed pivoting and potentially things getting bad enough in the economy, both globally and domestically, that's where Bitcoin could actually put in a bottom and start performing along with gold.
Cryptocurrencies aren't looking too good either, as Gareth says Bitcoin and other cryptos still haven't made their final lows yet. Looking on the monthly chart, it can be seen how Bitcoin seems to be breaking below the bear flag. If it is confirmed, we could potentially see 12-13K Bitcoin in the coming few months. However, in case the Fed starts to pivot, we will see a dramatic change in investor sentiment and Bitcoin will continue to rally upwards.
I really do believe that we're now in a protracted, like a long-term sideways chop period. And I think, I don't know if we talked about this last time, but it's a great, in terms of looking at the macro, it makes a lot of sense. But look at like the Brazilian stock market, right? So if you look at, what does this look like, Paul? See this run up from 2002 to 2008? Look at that run in the Brazilian stock market and then compare it to what we just looked at on the monthly S&P chart. Look at this bull run here, right? It's very identical. And then what scares me about the U.S. equity markets, and listen, I'm a trader, so it doesn't really matter, but you have to look at what has it done since the 2008 high, and look at this. So you have not made a new high, not even close, on the Brazilian stock market since 2008. And now here we are 14 years later. And you could also say the same thing for the Hang Seng market, where, you know, it's another good comparison to what period we could be coming into. This is the monthly Hang Seng chart. So you could see back in 08, 07, you were up here, and all you've done is go sideways with some big dips in there. And I do worry that that's the future. We're looking at a future chart of the S&P 500 here.
As Gareth just showed us on his charts, we could be looking at something similar for the S&P 500 chart. It is highly possible that we enter a very long period of consolidation where no new highs are made for a very, very long time. The Brazilian stock market is a prime example of it.
Yeah, I think silver and gold are good to start to accumulate here. I'm a big bull on silver as well as gold. Maybe not quite as big a bull on silver versus gold. I think I like gold a little bit better, mainly because gold does have that industrial side. So if we go into a global recession or even depression, you know, the question is how much demand for silver is there in addition to the store of safety? But having said that, if inflation is here to stay at 4% for the next 5 years, let's say, or longer, if the markets aren't going to perform, people are going to finally say, all right, where can I park my money that is going to be safe and maybe at least get me some return? And I think silver looks good for that. So, I mean, I'm a bull on silver. I'm going to erase some of these lines so we can draw on some new lines here. These are just more on the intraday. But since we're looking at the longer time frame, I would say keep an eye on this chart right here on silver, and look at this. Look at these trend lines right here, right? So basically we have a long consolidation pattern, and what we want to see is silver break above this line and break out, and then you could be headed back to $50. Now listen, we haven't broken out yet, But ultimately, if we do, you got major upside.
Gareth reveals that he is also bullish on silver as it is looking like it's ready to break out and retest the $50 high. This, however, all depends on how high the inflation gets and how long a recession lasts, along with the fact that there needs to be demand for silver other than its value storing purpose.
Yeah, so oil, my mid to long term, and midterm we'll call 6 months to a year out. I think by mid 2020 to late 2023, we're looking at sub $50 oil. And this goes to counter trend to what a lot of people have talked about. Everyone was saying, oh, it was going to go to 150, then 200. But what people aren't getting, and this is what drove me nuts back when we were at 130 after the Russia invasion, is that the loss of demand, the shrinking global economy, the amount of barrels that won't be consumed by recessions is way, way bigger than the amount that Russia's not selling, even though they're still selling it to China. But even just the OPEC cuts, I mean, we are talking about a massive reduction in demand globally for oil, and therefore oil is going to continue to go lower. I mean, sure, you'll get your bounces, but I see oil going quite a bit lower by 2023.
While many expert analysts were expecting oil to go to $150 per barrel, Gareth predicted the opposite, and it is actually playing out like he said it would. The demand for oil will drop significantly, so much so that Russia cutting oil supplies will not even matter, which is what leads Gareth to believe that oil will be much lower in 2023. Thank you for watching this video. Please drop a like and subscribe to our channel because we upload educational content like this on a daily basis. See you guys in the next video.